CMHC has released their Q3 housing market assessment, and they have increased the risk of a sharp reduction in housing prices from moderate to high. And they've increased the risk rating in several Canadian cities. We're going to talk about all that today and talk about what that means for the economy and what it really means for the housing market to be at high risk and whether or not we should be worried about that. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers. We're one lucky subscriber when we hit 25,000. Thank you to the 17,500 or so of you who have already subscribed. When we hit 25,000, we're going to give away $5,000 to put towards your TFSA, your RSP, maybe your down payment, or to pay down your mortgage. Whatever it is for you, if you are the winner, you get to decide. But in order to win, you have to be subscribed. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss the latest risk rating from CMHC and understand here that CMHC's job is to understand what's going on in the market so that they can assess their portfolio and basically understand their risk with respect to if the market were to crash. So what they do is on a quarterly basis, they go through all the major cities, they take a look at what's going on and they say, hey, where are we at with respect to risk in the market? And that's what the market housing outlook is. That is what they're looking at. They're looking at the risk in various cities across the country and trying to figure out where their greatest risk lies and where they can be more comfortable in the market. Now, here's some highlights for you. There's now 6 cities in Canada, according to CMHC, that are high risk of market vulnerability. And there is about a 21% increase in the benchmark price across the country year over year, which is a pretty significant increase and is therefore the reason why some of the numbers are pointing towards higher risk rather than moderate or low risk. So let's get into it. I want to show you the numbers here and show you where we're at. So this is the overall chart. I'm going to go through city by city, starting from east to west. And I want to point out first and foremost this one and show you basically the market vulnerability numbers that have moved from moderate to high since March of 2021. You can see that red dot, that means high risk. And if you go and you take a look at the individual pieces of the market, you can see that the one that has increased here has gone from low to moderate across Canada is price acceleration. So in other words, the growth of prices has continued to run at a higher rate than normal, which has caused them to move this from low to high. So that is the big reason why we're seeing that combined with a bunch of other areas where we have moderate ratings. That is why you're seeing a high market vulnerability across Canada on an overall average. And then you can see in various cities here, we've seen things go from either moderate to high, or you know what, there isn't a lot of places where we've seen it go from moderate to, or from low to moderate. But what's interesting here to note is that you see in Vancouver, we've seen it go from moderate to low with respect to overall vulnerability. So we'll get into that and why that's happening, but kind of interesting considering how valuable the Vancouver real estate market is. By the way, just as a quick aside here, if you're looking at getting into the mortgage market, if you're already in the mortgage market, if you want to find ways to insulate yourself against what's happening in the Canadian real estate market and the market vulnerabilities, well, a lot of that has to do with your mortgage strategy and saving and so on and so forth. So we've done something we've never done before. We have a new supply of books, The Mortgage Millionaire. We haven't promoted this much on this channel because we've been out of these for so long. We've got a new supply of them, and you know what? I'm doing something I've never done before. I'm giving them away for free. So if you want to get a copy of The Mortgage Millionaire, all you have to do is pay shipping and handling. Go to themortgagemillionaire.ca, put in your information, and we'll send you a copy absolutely free. Let's start, and we're going to go from east to west here. Let's start with Halifax, take an overall look at what's going on there. As you can see, nothing has changed in the last quarter with respect to the market vulnerability. Market vulnerability is still deemed high because 3 of the 4 sections that we're looking at here are at moderate. And if you go ahead and you take a look at overheating, price acceleration, overvaluation, those are all at moderate levels, and excess inventories are at low levels. So what you can see is that we're at low levels with respect to excess inventory. What that means is that there's low levels of inventory, which is a good thing because when there is excess levels of inventory, that could lead to a price collapse, which is why low inventory is seen as a good thing versus excess inventory being seen as a bad thing. And by the way, they're looking at renting and housing for sale here when they look at those numbers. Now, if you look at overvaluation, that is in reference to the overall values in line with jobs and other economic fundamentals. Obviously, they're still at moderate levels. Price acceleration, that is the rate of growth. We've talked about that already. And overheating, that is in general when sales are in excess of new listings. So in other words, there's more houses being sold than there are being listed, which leads to potentially higher prices. And anytime that happens, that creates the potential for a collapse for when those inventories start to come back online or sales start to slow down, people get tired out on the market, and so on and so forth. So if we look at the CMHC report here, the highlights are this. There's economic recovery happening again in Halifax. The housing market remains overheated. This is primarily due to elevated sales in the first 2 quarters and following the rebound in the second half. And moderate evidence of overvaluation is still detected in the market because observed house prices exceed the estimated fundamental housing prices. So in other words, housing prices are increasing faster than what the other economic fundamentals are, and that's why they're seeing that as overheating in the market. So that's Halifax. Now, moving into Moncton, we see pretty similar story here with the exception of overvaluation. They're seeing that overvaluation is in high vulnerability right now. And if we look at the highlights for Moncton, they are basically saying that housing prices have continued to grow in 2021, 23% increases year to date, reflecting the underlying disconnect between the supply and demand for housing, and evidence of price acceleration and high evidence of overvaluation led to a high degree of market vulnerability in Moncton. So basically what they're saying here is that there's significant overvaluation. So in other words, housing prices combined with lower interest rates, etc., are exceeding what you would expect with respect to employment and jobs and so on and so forth in that area. Now, moving on to Quebec City. This is obviously one of my favorite cities in the world. Quebec is in a pretty good place right now. So market vulnerability is very low there. They've got a little bit of overheating. The price acceleration has come down, which is a good thing. This is in contrast to Montreal, where it's a completely different story. You'll see that in a second. And then with respect to overvaluation and excess inventories, everything looks good there. So, Quebec, this was a city that was asked about in the comments recently. Things are looking still pretty normal in Quebec, still a really good place to buy. Now, moving into Montreal, if we go and take a look here, this is a city that has moved to a high level of market vulnerability, and that is primarily because overvaluation has moved from low to high. And what that means is that they're just seeing higher prices than they would normally expect based on what's happening in the job market. And this is one of the 6 cities that is now at high market vulnerability. And it is, just creeping into those higher prices and whatnot. Our Montreal clients, they are telling us that things are still a little bit crazy there and there's still lots of bidding wars and so on and so forth. So Montreal has moved to that high level of vulnerability. Now, with respect to Ottawa, no changes here. Pretty much everything across the board for Ottawa shows as moderate levels of risk, and therefore the market vulnerability there is extremely high. If we go and take a look at the highlights of what's going on in Ottawa, employment recovery in the public sector has supported the economy. Sales began to trend down since April, which is a good thing. The high rental market inventory is only a temporary phenomenon once student and immigration flows resume supply shortages. So basically what they're saying there is that they have a pretty high level of vacancy in the rental market, but that is largely in part due to people not being at school. And imbalances in all housing market indicators have maintained our assessment at high degree of vulnerability. So a little bit going on in Ottawa. They're still highly vulnerable, but one of the few cities in Canada that is at moderate risk in all 4 of the categories. Moving on to Toronto, this is always an interesting one. One of our most watched cities is Toronto. And if we go ahead and we take a look at what's happening there, they've increased the overheating rating to moderate. That means that there's more sales and listings. One of the things that surprised us about the Toronto real estate market is that new listings isn't as high as we expected them to be. You can see price acceleration is still high. Overvaluation, though, they're saying that this isn't a risk, but excess inventories, what they're saying there is that there's a lot of inventories and probably a lot more in the rental market and the condo market than in the single family home market, but that all leads to the market vulnerability being quite high in Toronto. Moving on to Hamilton, everything's pretty much the same as Q3 here. Moderate levels in overheating, price acceleration, and overvaluation. Excess inventories are still low, which is a good thing. And overall market vulnerability is at a high level. Now, what seems to happen here is that if 3 out of 4 categories are at moderate, that leads to a high vulnerability level as far as CMHC is concerned. Now, moving further west to Winnipeg, overheating and price acceleration are both things that have moved from low levels to moderate levels in the last quarter. Market vulnerability is still showing as low there, but basically what we're seeing is we're seeing growth in housing prices there, and we're seeing lots of sales compared to listings. So, a little bit of a hotter market in Q3 for the Winnipeg market. And I suspect as we go into Q4, that's going to heat up a little bit more. We could see Winnipeg as one of the laggard cities in the country when it comes to real estate. We could see this moving into moderate market vulnerability by the time we hit Q4 or Q1 of next year. Regina, everything in Regina is still pretty much low level from a vulnerability standpoint. The one thing that's interesting here is that they tend to have a little bit more available inventory, and that is something that is consistent across the last few quarters. But for the most part, Regina is still a very reasonable place to buy property, a very affordable place to buy property, and a market that hasn't been insane, although it has been a little bit hot like everywhere else. Saskatoon has lower inventories, obviously, than Regina does, and everything else across the board with respect to Saskatoon is at low risk, and that leads to low market vulnerability in that area. Moving into Calgary, in the beginning of the year, we saw excess inventories in the condo market and the rental market. This is because of the crash in the oil economy since 2014. What we're seeing is we're starting to see that excess inventory start to be swallowed up, and therefore Calgary's market has actually gotten better. It's one of the few markets, including Vancouver, that's actually gotten better since Q2. And as a result, we're seeing the market vulnerability still stay moderate because we're at that moderate level when it comes to inventories. But if inventories start to balance out, which it looks like they are, we could see Calgary at low market vulnerability by the end of the year. Edmonton, similar sort of story to Calgary, a little bit of overvaluation there compared to jobs and income numbers, but very much still stable in that market. Moving into Vancouver, this is the interesting one. So no real changes here from the perspective of overheating, price acceleration, overvaluation, and excess inventories, but market vulnerability overall has come down to low. Now let's take a look at what's going on in Vancouver there and see what they're saying about the actual numbers, because here's the highlights for Vancouver. Vancouver's rating was reduced from moderate to a low degree of vulnerability, suggesting a lower risk of a market downturn in the second quarter. Price growth has settled down in Vancouver as the pace of sales in the market has slowed, so that's a big reason for this. Young adult employment has improved considerably in the past 2 quarters as more businesses have opened and homeowners have listed their homes in larger numbers than usual and eased the competition among buyers. So basically what we're seeing here is we're seeing all the data in Vancouver leading towards a more balanced market, and that is especially good considering the price growth that we've seen in that city over the long term over the last several years. Now, moving one step further to the west, and this is the last city that we'll cover, last city that CMHC has covered. Overheating has moved up from low to moderate. Price acceleration has gone from low to moderate. Overvaluation, interestingly enough, has gone from moderate to low, and excess inventories is low for an overall rating of moderate market vulnerabilities. Want to see what's going on in Victoria because it's interesting that the overvaluation number has come down, but the other data has gone up. So the degree of market vulnerability remained moderate in the second quarter of 2021. Evidence of overheating and price acceleration are now detected. Record low listings have kept the Victoria market at a seller's market condition, albeit detached home sales are showing signs of slowing down. Price continued to accelerate as demand partially shifted from single detached homes to attached homes and apartments. With limited inventory, competition remains fierce among buyers, and substantial gains in the job market in Victoria contributed to income growth and home value appreciation. So the reason why we're seeing this overvaluation number come down is because of the growth in incomes. So, interesting. We're having another factor outside of the real estate market affect what's going on with respect to overvaluation. So really interesting things happening here in the Canadian real estate market. And, it's something that when you look at these reports, what you have to look at is they're looking at it from a risk perspective because they're an insurance company. That's what they do. If you go and you ask real estate companies, they're going to say everything's good in all cities. If you go and ask different economists across the country, you're going to get different answers. So how do you manage this? How do you deal with this? And the answer to that is really, really, really quite simple. If you are in the process of purchasing a home, get into purchasing a home at the soonest opportunity that you have. And what I mean by soonest opportunity is you've got the down payment to do so, you've got job and income stability, and you know that you're going to be able to afford that house for the long term. Because at the end of 25 years, when this mortgage is paid off, whatever happens tomorrow, whether it's a massive increase in prices or a massive drop in prices, is just going to be a tiny blip on the radar 25 years from now. So you shouldn't necessarily be making your purchasing decisions with respect to risk of the housing market, but more with respect to your own risk tolerances, how you feel about your prospects of being able to purchase and maintain a mortgage on a property. And if you can do that and you're comfortable with that, you're comfortable with your job security and so on and so forth, and the amount of money that you have in the bank account, then buy at your earliest opportunities. If you're in low risk markets, you're good to go. If you're in higher risk markets, yeah, you probably need to consider whether or not you're buying in a market where you could end up house poor, and you need to think about your decision making with a long-term perspective in mind and not just a short-term perspective. So in other words, if you're in a high risk market and you know you're going to buy and sell and want to be out in 3 years, probably not the right time to do it. But if you're thinking over a 10 or a 15-year span, then you're probably going to be in an okay place regardless of what you do. So that is CMHC's housing market report. I find it really interesting. There is some really interesting things happening across Canada. Obviously, they've moved the overall risk in Canada to high, but they've moved that risk in Vancouver down to low, which I find is really, really interesting. I tend to find that Vancouver's market is more or less the overall leading barometer of what's happening in the Canadian real estate market. So I have to think, at least I hope, that a lot of markets across Canada are going to come back to a low risk rating over the next year or two. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about our race to 25,000 subscribers, and we'll see you on the very next video. Cheers.